And start the recording. So good morning, November 10th. We are almost to the midterm point of our class, and we have been doing great on the homework. I know we've had a couple questions. I'm going to try to spend some time more so with the problems today. A couple of the topics that we're going to cover today, we're going to be doing, let's see here, capital gains and retirement. So we'll be covering those. Those don't take long, so we can talk about some of the other things that we have questions about, especially the software. I know people, it's tough when I'm not right with you in the classroom about how the software works, you know, how you find things, how you find worksheets. I'm just hoping that when we record the sessions that you can see most of this and have it work there. Also today, if you got questions, just because of the way I am set up today, let me know. I am, like I said, I'm kind of running this off of somewhat of a rigged system with my laptop and an extra monitor. So as we speak, I'm trying to get the software up. So we'll talk about that. Like I said, the homework's been looking great. I've been assigning things kind of based on, you know, the problems that we can have come in. The exercises are such that, you know, just focus on those as far as understanding the content. As I've said before, kind of understanding how the forms and the worksheets that are within the forms, how those work. So those are those. The quiz, again, kind of reviewing topics. I'm not too worried about going through the quizzes with everybody here. In the classroom, we usually do them as a group thing. So at this point, though, I would like to open it up to any questions that anybody has about any of the content. And again, I apologize if I'm doing some stuff here. I'm trying to get TaxWise onto this computer. And as you know from downloading it yourselves, it does take some time. So I'm trying to get that up and running for everybody so that I'll have that. Okay. All right. Let's see here. The Puerto Rico one, you're not going to really have anything per se with Puerto Rico. What happens with the software, you have a student version, and some of the things that come up red, I know a lot of people, I've had a couple emails and messages that everybody has that high anxiety when they see red exclamation points all over their return tree on the left. A lot of that stuff we set up for the offices, for the preparers, we set up what we call defaults, and some of those are pre-answered. Okay, so don't get caught up on the Puerto Rico one. That'll be defaulted for the answer. I can probably say, you know, doing 1,200 or more returns a year for about the last 5 or 6 years. I have not done any Puerto Rico ones. That's why some of these we do default, so that they just kind of have you all set on those, that you don't have to worry about answering anything on those. Okay. Yep, and I'll get the homework assignments out. Like I said, we've been moving, so I've had some things technical-wise, trying to get the recordings edited. So, but I think I should be able to do it today, get those out. So hopefully you'll have those before the end of the day, that we can have the recordings and the homework assignments and send out. I don't have access right now, but I will have those for you too. Okay. Let's see. Exemptions. You check yourself and spouse. Okay. We had a question on there that exemptions, they should already be defaulted to have the exemptions on 17 for you and your spouse. Again, some of those things are defaulted in as long as they are entered with the Social Security numbers when you do that. Healthcare, if it's paid by other spouse for child, where does that go? So if we're talking about a situation that a parents are separated or divorced, we would have a two separate, and it's sometimes the case that the custodial residential parent has the child and the insurance is covered by the other parent that does no longer live in the house. So in that case, you can just check the box that they had all 12 months. Basically, they just have to meet the minimum essential coverage, which really truly is basically hospitalization and emergency room. You don't have to have insurance. For an example, Medicare Part A meets minimum essential coverage, and anybody that knows Medicare, that is just Part A, and that is the hospitalization. Okay. Yes or no, check. Child tax credit, that one comes up. That is almost part of your due diligence for the child tax credit. Basically, you have to just check that they did not have it, that it was not disallowed the previous year for some reason. Okay. Same thing with the EIC worksheet. We'll kind of go through that as far as what to check off there. Again, it's a due diligence, reading the questions. Once you make sure that you put in everything on the main info as a preparer, then you go in there and you would do that. Okay. That, everything there. Okay. All right. Any other questions on anything from the chapters? Let's see, 1 through 7. Again, just remember refundable credits. Those are the ones that I can sympathize, Pat. I had a little internet trouble myself. So the refundable credits are the one that go on and on and on. Non-refundable credits that we talked about last week, those are ones that eat up our tax bill. They're kind of in a pecking order, if you will, the way they're arranged on page 2 of the 1040 in that section. And so, that's where they have. And, we talked about the adoption credit having that component that is a carryover. So, the ones that have no carryover or maybe no refundable portion are the ones that tend to be used first. Prime example is we probably would use the dependent or child care credit before we would get into the child credit. We use the dependent credit first because we want to try to eat up that tax bill, something that's going to go away. Okay. All right. Okay. All right. Let's see. Okay. So we have that. So what we're going to do, and if anybody, let's see here. If you claim child but other spouse pays health on questions, what you check. Just check that they had it for the 12 months. Basically, you just have to justify that they had insurance from wherever it comes from. That's really the only thing we have to make sure on our due diligence. 18 is the last year for the shared responsibility penalty. So this will be the last year that we have that on the returns. Okay. Yeah, just make sure you check it and, check that first of the 3 boxes after the name. Like I said, I probably won't, I got to wait for everything to download here. So I would go into a return and kind of show you some of that, but we'll make sure. And let's see, I'm in an office without a pen. Hold on. I'll make sure to talk about that ACA worksheet. Okay. All right. And again, I hope everybody can hear me okay and see me. I know the light's a little different. I'm used to this is a camera off my laptop, and it seems to be working okay. All right. So, and again, if you guys want to pop on the mic and talk, that's fine too. Just make sure that you turn it back off because maybe somebody's doing this on their phone as they're driving through the drive-thru at Tim Hortons, and we don't want to all be jealous as you're ordering your breakfast and everything for us. Okay. All right. Okay, everything looks good. Okay, all right, so let's go ahead and get into the next couple chapters here. 1 second. And where do we go? All right, give me a second here. I got to get situated. Way too many things going on here. Okay. All right, so we're going to talk about retirement plans. Okay. Whoops, I'm sorry. Got to get back to chapter 8 here. Capital gains. All right. If reading these chapters, there was a lot of content that really we don't need to cover right now. It's introduced because it is part of the capital gains, but per se for what we're at this point, a lot of the stuff you'll hear me defer to our chapters 13, 14, and 15 when we cover Schedule C's and Schedule E's. So, that's where we'll cover those. But we're going to talk a lot about basis of property. That's one of the big things that comes into play. Sale of investment property, again, I'm going to defer that when we see it in action because we need to really have the components of depreciation as part of our repertoire of skills. And so that will kind of defer. There'll be content here for you to just kind of understand that things, but most of what we're covering right now is going to be based on the basis, okay? We'll talk about sale of personal residence. And the big thing that we're going to cover, and most of it is, we're going to talk a lot about stocks, investments, things like that with the capital gains, how it's determined, and what we do with that, really how the Schedule D works in tandem with an 8949, okay? Page 8.3 there talks about capital gains. Really what it is when you have things that are classified as a capital asset, for instance, your home, a car, household furnishings, jewelry, collectibles, stocks and bonds, obviously, you have a basis in that. And basically what that is the cost. What did you pay for it, or a fair market value, okay? We can dispose of that asset, have a gain, or we can dispose of that asset and have a loss. And we're going to talk about how to handle that, okay? So we'll talk about a lot about that. When we have losses and gains, they're obviously taxed at a little bit different. We'll talk about how that works within the tax return based on things. But, the taxing and how that works is also plays into part not only as far as the gain, but also if it's short-term or long-term, okay? We have a short-term, which is 1 year or less, and we have a long-term, which is greater than a year. And that's how long we've held it since we've owned it, okay? So we want to make sure that we understand, that's the first thing that comes into play when we go to look at that tax, okay? All right, hold on 1 second here. Somebody didn't get that. Give me 1 second. Somebody's computer didn't get the Zoom code, so I'm just going to forward that to them. All right. Okay, so like I said, we have short-term and long-term, okay? Really the objectives, what we're going to have here is the Okay, really what we have is we're going to talk about the basis, like I said, the tax consequences when we sell, or the losses on the capital gains. We're going to talk a lot about people selling their homes. Sometimes those things get confused. People get concerned when they go to sell their home for the first time, or something else, or a home that maybe is coming from mom and dad. Had a couple meetings yesterday with some folks about the gain on selling somebody's home. Okay, and then we're going to talk about how these capital gains are reported on a tax return. All right, so the basis. We have three bases. We have the cost basis, the adjusted basis, and a basis other than cost. Okay, so we're going to use one of those three categories to determine what we have into the asset. What money do we have in the game, if you will. Okay. Cash basis is usually the amount paid for an item in cash, debt obligation like a loan, or anything like that. It does include sales tax, shipping, installation, testing, other tax, revenue stamps, and fees. So basically, if we buy anything, we can add anything that becomes out of pocket and an expense to us, not just the base price of whatever we bought as an asset, but anything else that comes along with it. Okay. Base price for the stocks is usually the purchase price plus commissions and other fees. When you buy stock and you're given the value of it, that's usually taken into account by your broker. So, that's where that comes into play. We will get into this a little bit more about the basis of real property and land value. Usually when you go to put a basis in, say that you bought a rental and you bought it for $100,000, usually it tends to be that the standard is about 10% of that is backed out for the basis. So it really would be put in at $90,000 because we back out that 10% for the value of the land, which cannot be depreciated. So that's not put in the basis. Okay. All right, we have the adjusted basis. It talks about before you do a loss or gain on a sale or exchange or dispose of a property, there's things you can do to adjust the basis. Okay. Increasing the basis of the property, improvements. Best example is you have a house. Anytime that you do something that would be a capital improvement, such as a roof, siding, things like that. Paint doesn't count, but anything that would have increased the value. Yesterday, like I said, I was working with a couple. One thing they forgot to add in was a driveway. So they had that, because that increased, if you will, the curb value, no pun intended, but the curb value for everything. Okay. Decrease in basis. Those are things that, return of capital for the period during which the property is held. Okay. So, for some reason, every time I talk basis and capital gains, I always got my hands like this, and I don't know where I picked it up, but I do it. And basically, I have my basis, I have what I sold it for, and this is kind of our ceiling, if you will, and we try to decrease and adjust the basis. Sometimes it adjusts and goes up, sometimes it's decreased. Okay. That's why, like I said, the decrease in basis, we're really going to see a lot better application of that when we get into chapters 13, 14, and 15, and we talk about, selling something that we have in our business or as a rental, and we have to recapture depreciation on that. Okay. Basis other than cost. Basically what that is you don't know what you paid for it, and you don't have the adjustments, and as it says there, in these cases, fair market value or the adjusted basis may be used. Okay. Again, sometimes you buy things or you inherit things and nobody has any idea what the value is. It even sometimes comes with stock. Sometimes the cost basis of stock, when it's changed hands between several brokerage houses or maybe had a split, we can't really determine it. We have to do our best, and we'll talk about that, determining that basis. But we want to make sure that that when we do that, we find the fair market value of it best we can. Okay. All right. Great little chart here on page 8.6. Talks about increases to bases and decreases to bases. Okay. You know, sometimes we have things that may decrease the basis, and one of the things it talks about there is casualty or theft losses deductions and insurance reimbursements or things like that that may impact the value. Like I said, the biggest thing we're going to see and talk about later is the whole depreciation in section 179 deduction that talks about. And again, don't want to bring that into play right now till we really see and get a feel for depreciation when we're doing our business and rentals. Okay. All right. Okay. There is a little thing in here, and again, we're going to take this back. You know, as far as we'll talk about it more when we get into the business income and things. Talked a little bit about some exchanges, the like-kind exchange and things like that. Again, I want to wait and cover that really more in depth when we're in chapter 13, 14, and 15. Okay. All right. Little definition of fair market value there for you in the box. Is the price at which the property would change hands between a willing buyer and a willing seller. Usually the best example I always come up with for fair market value is you know, things that are collectibles. Best example would be a baseball card. Okay. It's hard to put a value on a baseball card. You know, obviously, if you bought it and have had it for a while, you probably bought it in one of those penny or nickel packs that somebody had of Babe Ruth or whatever. And, you know, that basis is hard to determine. You know, you can do best you can, but, you know, as far as the value when you sell it, you know, whatever somebody's willing to pay for it. You know, there's not like there's a fixed market for values on things like that. So again, a willing buyer and a willing seller, that's what really determines that price as far as selling. Okay. You'll have some little exercises there, very good ones there that talk about determining the basis. Okay. All right. And hold on one second here. I don't see Angela yet. One second, I apologize here. Got somebody that hasn't. Let's see if she gets it that way. All right, sale of investment property. Again, you know, this is something that's going to really talk about later when we have, you know, what we think of as investment property. When we talk about a rental home or something like that. Mainly what we're going to talk about right now is the sale of stock. Okay, stocks, bonds, commodities, things like that that we might have in an investment brokerage account. Okay. All right. Okay. This little statement that you see here, this is a Form 1099-B. You know, again, this is something that we have. I believe and you'll see this as far as the 1099-B quite often. You see this as our homework and things like this, but you will not see it in this manner when you actually have it in the classroom, or excuse me, in the tax office. This is kind of a classroom one. The 1099-B that we'll see most often is one that has a little bit more of a flavor with you know, as far as the looks like the brokerage account ones, and we'll bring that up in a second here. Give me 1 second. All right, so what we have here, this little statement here, and again, I apologize that it's sideways, and that you can see down here at the bottom, this 1099-B is really all together here, and it has it for our Form 8949 that we'll see when we do the problems in the text or the workbook. But on this one, they're going to be classified as basis reported, basis not reported, or something that we never received a 1099-B for, so that we're going to have it like that for short term and long term. Okay, and some of them, they just don't determine anything. Okay, so you can see that there's a proceeds and a cost basis. And again, I apologize that it's sideways, the way it's scanned in. But that's that example of what you typically see, and it'll look a little bit more like this as far as the transaction, where we have the the different stocks. We have the dates that they purchased them or disposed of them, the date acquired. So that's where we do the short term and long term, and we'll look at the basis. May have some adjustments, and again, we'll see this a lot more in practice when we do the actual problems. Okay. All right. But for most of our problems right now, we're just going to see it in this traditional, or what the IRS calls its 1099-B. But again, in practical matters, we really don't see anything that comes out this way. On the box, you'll see the date acquired, the date sold. It may have a description of it. Sometimes in here, it may just have the stock exchange code for it. We'll have whether it's a short term or long term, that things, sometimes tax will be withheld. And then it talks about here that how the proceeds were reported or not reported to the IRS. All right, so we'll have things like that. And like I said, in this one, this is kind of what we see as far as what the form will look like in our problems, but it's not really what we see in a practical sense. All right. All right. Talks about a little bit here about amount realized. That's the, everything that the amount realized includes the money received plus the fair market value of any property or services received. Okay. And then it talks about the difference between the recognized gains as far as what those are included in. A lot of times what happens with brokerage accounts is things are taxed, in dividends. You see capital gains sometimes on those 1099 DIV. Sometimes the capital gains in the stock and what's added to the basis, you're paying tax as you go along. That will be taken into account. So you sometimes realize these gains and pay tax on them. They never really come to your pocket, if you will, or where you get a check for them. but you recognize them and you pay tax as you go along on them. And that would be the job of the brokerage house, that the basis of your stock would be adjusted for that. And then when you do actually go to sell the stock, your basis will already be adjusted because some of that has already been taxed on capital gains. Okay. All right. These are some non-taxable, and again, you know, the one that we're going to see a little bit of is the one that's in the middle here. This one is the, like I said, comes into play with rental properties, such and things like that, called a 1031 exchange. What that is basically it's kicking the can down the road, okay? And what I mean by that, if I own a investment property and I live in New York and I've decided to retire to Florida, and I don't want to keep my rental property in New York, I can do a 1031 exchange where I would sell the property, use an intermediary. We have one that we work with. His name is Russ Gullo, who's licensed to do this. The property is sold, the money's kind of put into an intermediary sense, and then on the other end, when I get in Florida, I buy another rental property. So at that time, I don't have to, it's a non-taxable event on the sale of that investment property. So like I said, you know, then it's rolled into the next investment property or that I might have in Florida that I'm renting, or maybe I bought a double or a duplex or condo where I'm renting half of it. And, you know, then my basis and everything's kind of rolled into the new one, and I don't have to pay any capital gains at that time. At some point, you know, we know the IRS, they're going to want their share, so at some point they are going to pay, you'll have to pay tax on it, but this is a way to kind of, if you will, defer your capital gains tax. Okay. All right. Okay. Again, a lot of different things here about different things as far as the property and different values, how those values are determined. You know, again, we'll come back to some of this because a lot of this talks about property that may be such that is a has to do with a business or a rental. Okay. Sale of personal residence. Okay. Again, this is one that everybody comes in, and if somebody's never sold their home, we get a lot of calls and say, hey, I'm selling my home. What tax am I going to have to pay on it? Well, you know, most times somebody selling their home, it's not a taxable event. And as it says here, you can exclude a gain up to $250,000 for an individual or $500,000 for a married filing joint. What that means is that is the gain. Some people read this or hear this number and says, well, I sold my house for $275,000. Does that mean that I have to pay capital gains? No. As a single person, only if you made a profit of $250,000. So that means that that $275,000 house, he would have had to bought it for $25,000 before the capital gains would kick in. Okay, $500,000. You know, again, somebody buys a house for $1.5 million. You know, they would have to have $1 million that they paid for it. So anything above the $1.5 million would then be capital gains and taxed. Okay, so you can exclude that amount. All right, and for those of us in the housing market in Western New York that buy and sell, you know that it is very rare that you find transactions for homes in Western New York that have that value to them. Okay. If you're buying and selling a house as a married filing joint and making more than $500,000, I would guess that you're probably hanging with the Pagula somewhere along the line. Okay. All right. The main home, again, sometimes people don't realize it can be a houseboat, mobile home, a co-op, condominium, things like that. Okay. Does it impact if you sell your personal residence, but you have taken the home office deduction? The home office deduction, not as much impacts it because it's on the business. You know, there is some, you're not really depreciating anything that you're taking in there. You can get a little bit of a recapture, but it doesn't really impact it. To get away from some of that, when we get into Schedule C, the IRS has been basically giving a $5 per square foot fixed amount. So there's not really any recapture that you're thinking of that we really need to work on. It's a shame, 2018, home office for somebody that's a W-2 employee is gone. So it no longer exists. So you would have to be self-employed in 2018 to write off your home office. Okay. All right. The thing with the house too, with the exclusion, you're eligible for the exclusion as long as you've lived in it for the 2 of the last 5 years. Okay. And so that is just 2 years out of 5 that it has been your primary residence that you have lived in. Now, sometimes what we see with this is somebody maybe has gotten married. It was their personal residence for a couple years. Then they turn it into a rental and have some appreciation. So obviously you got to break it down between the 2 transactions. Just because they lived in it for 2 of 5 doesn't mean they get the exclusion even for those years that they had it as a rental. Okay. All right. Okay. Talks a little bit about here too. If somebody owns more than 1 home, the big thing with owning more than 1 home is that you have only 1 that can be excluded if you sell it, and that has to be your primary residence. And obviously, we use the example again where we talk about somebody that lives in New York and somebody that lives in Florida. As it says here in the example, from 2013 through 17, they lived in New York home for 7 months and the Florida residence for 5 months. In the absence of fact of circumstances, the New York home is their main home. The gain from a sale of the New York home could be excluded, but not the Florida home. Okay? The taxpayer owns a home but lives in another home that they rent. The rented house is their main home. So again, it has to be that primary residence, okay, where we have that. Okay. All right, so we have some things that would determine as to where our main home is. Obviously, if your mail goes someplace, your voter registration, where you're registered to vote, the address on your federal and state tax returns. And then obviously, establishing residency, one of the most important things would be your driver's license. Okay. The other thing is the IRS will look at which home is near where they work, where they bank, family members, or where they attend church, or maybe their golf club. So if that person's in Florida and they're playing golf there 7 months a year, then they're probably going to determine that that is their main home. Okay. All right. Okay. Little thing here, the little example. I actually used a similar thing yesterday, like I said, talking with somebody about the house they sold that they had inherited from mom and dad, and kind of using the selling price minus selling expenses and the amount realized, and then once that amount realized, you use that adjusted basis, and that determines your gain or loss. And again, that adjusted basis, we go back to that table when it talks about different things that, from the value of the house when it may have changed hands or anything else, and then we adjust that basis based on things that may take it one direction or the other. The one thing about the sale of a personal residence, a loss may not be deducted. What that means is because the IRS is doing the exclusion on gain, they don't allow you to take a loss. Okay, so there's no loss that you can do as a capital loss on your tax return for the sale of your personal residence. All right. Business use of a rental of home. Taxpayer may be able to exclude the gain from the sale of a home used for business or to produce rental income, but the ownership and residency tests must be met. Any depreciation previously claimed or that could have been claimed must be subtracted from the selling price. So Tony, kind of going to your question there, the minuscule amount that you would have taken for your home office if you're doing a actual you would have to recapture within that. You know, usually that is a pretty small percentage because we're basing, you know, maybe 6 or 7% of our house maybe that we are able to claim as a home office. Okay. All right. Okay. Selling expenses that may be included. We talked that commissions, advertising, legal fees, loan charges paid by sellers, such as the loan placement fees or points. What I do with my clients, and you saw in your reading that there is a thing called a 1099-S for the sale of that property. That's great. For me, if my clients have a transaction with a home that they're wondering what's going to happen with, is that I'd much rather see that closing statement or that HUD-1. If anybody's ever bought or sold a home, they know what I'm talking about with the closing and the HUD-1s. You see that give and take. And that works out much better to determine and help us know and find all of the different things that we can do to adjust our basis besides any capital improvement that has happened since we took ownership. Okay. All right. We'll talk about, again, some of this we're going to come back to when I get into the software because we'll be able to see where that selling and that transaction takes part. Okay. Schedule D is where our capital gains are reported. Okay. So that's where our gains and losses are reported. Schedule D, which flows over, as it says there, onto the 1040 line 13. Okay. Under the Schedule D, what we're going to talk about really today is the 8949. As I pointed out on that 1099B that you saw there, I had something that had the short-term, long-term, you know, basis, not basis, all the different classifications there. Okay. 4797, we're not going to worry about right now because that has to do with much more something that's been depreciated. So we'll talk about that a little bit later. Okay. Again, 8949, you're going to have some exercises here where you're going to have to create 8949 based on what your 1099B or your 1099S that has the sale with the basis and shows the gain. Nice thing about the software, we're going to have a worksheet where we just have to understand how we get that onto the worksheet, make sure we understand the classification, whether it's a basis or short-term or long-term. When we get that to that, we will be able to have it flow to the 8949. So the software does a lot of the work for us on that, but what I want you to understand is that each one of those classifications, whether it has a basis or no basis or unreported, 1099B, short-term, long-term, basically we have about 6 different 8949s that we could have on a tax return that are supporting documents to our Schedule D. Okay. One thing I will tell, and I tell everybody, is make sure that somebody keeps track of their basis. The basis of stock is sometimes hard to track, especially if somebody has this stock and it's been passed between several brokerage houses. Prior to the stock market's crash in 2008, you know, the records for basis were not kept very well. Okay. You know, example, I had an elderly lady that decided to sell some stock that she had in a utility company in Oklahoma that had been sold and bought and things like that 3 times. You know, she sold that stock that she'd had for several decades. We had to find a basis. Okay. And oddly enough, she was able to contact somebody in Oklahoma and they had kept great records. And she gave me a copy of what she had got. And it was the stock transaction on the old letterhead, and it had been typed on a Smith Corona, so you could see the old-fashioned typewriter. It had not been printed on a computer, and you could see even a couple errors that they had whited out and retyped so that they had that on there, but it was what we had to do. The other thing is there is a website called Big Charts. Let me see if I can bring that up for you. Give me 1 second here. Okay. Okay. This is a website that I use quite often. We're able to look, as you can see here, if I click on this part here, I have historical quotes that I can look up. So if I know my Microsoft and, I want to look it up for, they bought it on, we'll say, 2012. Oops. Come up here. Let's see here. Look up here. Hold on 1 second. I wanted to look up Walmart. Oops. For this date. Let's try 11. Okay, so I've looked up Walmart and it will give me the closing price on November 11th, 2013. Okay, so I can look it up. And if somebody does not have the basis, this is a way that I can find the basis. So as you can see up there, you just Google big charts and it'll take you to the website here. Okay, all right. Okay. But like I said, record keeping is very important with some of this because sometimes it's very difficult because the information is missing. The brokerage house, and even when you call them, says we have no idea. Okay. Little section here about multiple forms of the 8949. Again, our ABC or DEF, the different things that shows short-term, long-term, whether the basis or not was reported, or if we did not receive 1099B and it was done on a short-term or long-term. If we have to do capital gains on a home, that would be a long-term transaction, not reported on a Form 1099B. Okay. All right. Here's the Form 8949. Again, you're going to have some exercises where you're going to have to determine and check the box, fill in the 8949 with the different descriptions and such. The descriptions you see here, these columns, is something that the worksheet that we have within the software is going to look like. Okay. 4797, again, we're going to skip that for right now. We'll come back to that later when we get into our chapters with business and rentals. All right. On our Schedule D, there's different parts. Part 1 and Part 2, obviously it's divided between short-term and long-term. Again, some of these come over from our K1s or have to do with other property transactions, and we'll talk about a lot of those when we get into the sections that we have for that pertain to those, whether they be Schedule A's or Schedule C's or Schedule E's. Again, some of those are the chapters coming up. Okay. All right. Capital loss carryovers. Okay. Anybody that's had a capital loss, again, I relate back to what I talked about with the crash 2008 where stocks plummeted. I have clients that have well into 6 figures on capital losses that they're carrying forward. However, they can only use $3,000 of capital loss per year, okay? So they can only show a $3,000 capital loss on line 13 of the 1040. However, if I have $100,000 in loss that I'm carrying forward, but I have $50,000 in gain in a year, I can take and get rid of that gain and still show the $3,000 loss. That's where sometimes I'll hear clients say, well, my broker is selling some losers to offset my winners. Well, basically what they're doing is, they don't want to have to carry forward the loss, or they're trying to minimize the gains. Sometimes they don't need to do that, because if the broker knows that there's a carryover loss already that somebody has on their tax return, they already have those losers on record that are being carried forward to put against the winners. Okay, so that's sometimes where I emphasize with clients that they make sure that they understand that they may already have some losers on record to offset some sales and some winnings. During the 2017, obviously the market did a lot of growth, so there are a lot of people coming in that were going to be potential to capital gains, but a lot of people still had losses on record from the previous years going back to 2008. Okay, and you can carry over, and we'll show how those carryover happens, the calculation within the Schedule D. Okay, as it talks about there's the use of the short-term losses first for the carryover. Okay, a little worksheet here. Again, we'll show the worksheet within the software so you can see the numbers go in there. All right, so that we can show you how those all work. All right, capital gain tax rates. Obviously, the most important ones are down here at the bottom. Okay, so if we look at these last three boxes, we can see the capital gains rates, and basically these rates of 0, 15, and 20% are dependent on where a person's tax rate is. And again, that's the tax rate on their taxable income, not their gross income. So most of the people right now that you think of, and unless they are a very high-end broker or have a lot of investments or things like that, most of them are going to be in that 0 or that 15%. They have to remember though that that capital gain rate also, their tax rate and the capital gain rate work hand in hand, because if they sell stock or they sell in a rental or investment property, they will add to their income, so it may push their tax bracket up, which means that transaction will have a greater capital gain rate. So those are things that are important to always keep in mind when you talk to somebody about the capital gains. All right. All right. The one that I see most often for people, and when I talk to them as far as capital gains outside of the brokers, is the inherited home. When somebody inherits that home, mom or dad pass, the house goes to the kids or one of the kids or whatever it may be. Typically, the basis for that property is the value at the time of death, and then somebody would sell it, and the proceeds from everybody selling it, that's what the capital gains for each of the beneficiaries or whoever inherits the home. Okay, and a lot of people have to understand that. Sometimes based on the way their tax return works, they may not be liable for, because their tax bracket's low enough, they may not be liable, and it's a long-term or short-term or whatever it may be, but they may not be liable on the federal, but a lot of times it'll create tax implications on the state. Okay, so you always have to make sure that, we're talking a lot about the federal, but you always make sure that you bring the state into play too. A few exercises here. Again, things where you're going to be generating 8949s off of 1099Bs, then transferring everything to the Schedule D. Again, for the exercises, doing it the old-fashioned way with all the property, or excuse me, pencil and paper. It's to make sure you understand where that property and how it's taxed and how the calculations work out. All right. All right. Okay, so that's chapter 9 for right now. We're going to take 5 minutes. I'm going to make sure that I have my, oops, got a question. Hold on one second. Is the capital gain a one-time thing on the sale? No. You know, obviously, you know, you don't only get one get out of jail free card. Again, that's kind of a misnomer. People had always thought that you could only exclude a capital gain once. The big thing you have to do is make sure you pass that test, 205 years. Okay, and so you would have that on there. All right. Any other questions before we take a break here? Okay. All right, so we're going to take 5 minutes here. We'll be back. Like I said, I'm going to make sure that my software is up and running because I'm not on the computer that I'm typically on. So I'm going to make sure I can get into TaxWise so when we go to do some problems at the end of today. And then we'll go real quick through the retirement. It's not too bad of a section. Then we'll spend some time on problems. Make sure you look back through the problems you've done to this point. If there's any questions on anything, just let me know. Okay. All right, so we have that. Okay. So again, we'll just take a few minutes here. If anybody needs to freshen or warm up their coffee, and we'll be right back. Okay, everyone, we're going to get back out of here. We're going to do a couple problems. Just real quick, too, I sent out what I was referring to there about some of the additional forms, you know, that I talked about that I would have for you with some of the little things with the 1099R and railroad information, that K1 and 1099 B type of information. So I sent that out. We have, okay, oops. Okay, and can everybody see on the screen okay the little 1099R there? Somebody can type in the chat and make sure it's up there for you. Okay, all right, so we got that. Like I said, it shows a little bit better on the distribution codes. Again, I apologize, it's sideways. It's on landscape, but I was able to get it in there. This is where it talks about the retirement, the blue section. You can see the boxes that are there that are highlighted, where those will go. This is the one from the green section. Again, on this one, really the ones we're worried about are 5, 10, and 11. They will go on Social Security that we're going to see here. When we talk about some of the problems, I'll show you the Social Security worksheet, so those will go there. You know, the Medicare that we talk about. And then this is the green one, box 3, 7, 9, and 12. And on this, there's a little worksheet here that those boxes, and it says there for the RRB 1099R, where it goes on the 1099R that we're going to see when we do a couple of our problems and examples. A little cheat sheet here. We're going to talk about these boxes that show up on the software for coding for New York. It talks about 59.5 for the federal or the railroad retirement. There's a little sheet there about the simplified rule. And there's also one that's a little cheat sheet there, how you get for pensions for civil service employees in the retirement and how things go in there. So it's a little sheet that I think is handy for everybody to have, so that they have, you know, something that's a little easier than some of the verbiage that may be in the textbook there. All right. All right. All right. So we're going to go into a problem. All right. And we're going to go into our software. And what I've decided to do is I'm going to do from your workbook on page 8.4 in our chapter 8. We're going to do an assignment out of there first. We're going to do, we will do problem 1 there. It is Chris and Elaine Robbins, that are known as Christopher Robbins. So for those of you that are of the Winnie the Pooh generation or have grandkids and Winnie the Pooh, you will know who Christopher Robbins is. On there on page 8.4, we got some bullet points. It talks about Chris and Elaine filed a 1040A last year. Again, 1040A, first thing that should come to mind is that they did not itemize. Talks about how they would like to handle their refund and or if they owe money. We're going to use the forms to complete the return. They sold some stock, and they also make some contributions to a traditional IRA. A little early on this, you know, as far as it in there, we'll talk a little bit about it. Again, contributions to that retirement account come up in chapter 12 of our textbook. And then the Robbins had health coverage the entire year. Okay. All right, so we're going to get in there. We're going to start a new return, and we're going to have it under, again, Christopher Robbins, Christopher C. Robbins. I guess that's truly his middle initial. Again, for those of you that are Winnie the Pooh. Okay. All right, and we're going to try to spend some time. I know we've had some questions with the main info. We'll try to spend a little time on that. Okay. All right. Okay. 1 second here. This is a new install. I just want to make sure that 1 second from the wrong color scheme. Okay, that's better. Okay. All right, so we have, as we talked about here, we have Christopher Robbins. And again, I emphasize that you make sure that in the TaxWise software that you type everything in caps. It just makes it easier for later for the electronic version when it goes in for the transmission and diagnostics. It'll just make it lots more seamless there. Okay. He's married to Elaine. We have her in on the return there. Okay. We have home address. And we live down in West Seneca, New York. Okay. Obviously his friends. His email is poo@yahoo. All right. Okay. And we'll just put in his cell for right now. Again, very important with what we're talking about with retirement. But when we do the main info sheet, we have to make sure we get those birth dates in correctly because we need to know what their ages are. Okay. We have sales. And we have an RN. Okay. Again, you know, the people that are with the red and everything, are you excluding just check no. Okay. That default will be set up for you when you actually use the software in our offices or in electronic filing. We have married filing joint return. Okay. They did not have any dependents, as it shows up on the computer information sheet there. They file in residence of New York. Okay. And we're going to e-file this return. Talked about the fact that they like to handle their refund if they have one electronically as a direct deposit. And so we're going to put that bank information in there. Oops. Let's do 0. Okay. All right, so we have that. Don't worry about this one for the self-select, the practitioner pin stuff. That will be defaulted into the software. Make sure that you check your little box that says income tax return for the form that you're filing. This one we're going to put in the taxpayer's pin. Like I said, it's usually best just to use the zip code. It does not have to be that. They can choose one, but usually that's the best way. EOR firm name, again, don't worry about that. That'll be defaulted. Okay. Make sure you get that in there for both the taxpayer and spouse. Again, when we do returns in the offices or when that, you'll have to do the driver's license information, but we'll skip that for now. And just check the first box that says that we had level 1. Basically, we did not see a government issued ID, but we understand that they are who they say they are. Okay. And this one again will be defaulted in there. So everything will be set on that. Just make sure you use your preparer ID, set it up, and every time after that it should default and fill that in for you. Okay. And again, all this stuff will be put in there. I'm happy to say that I get to type our new corporate address. The phone number, for those that are interested, stays the same. Okay. If we go back to the bullet points that we talked about on the 1040A, okay, we have that. They said they filed the 1040A, I'm sorry, but on 1040 page 1, the little question in the middle box here shows that did they itemize the deductions last year? And that would be no, because they filed a 1040A. It said that Chris and Elaine had health insurance all year long. This was one of the questions that had come up at the beginning. If it were the case that on this return, Chris was the father and his daughter Elaine lived with him, but Elaine's mother, who's not on the tax return, had paid the health insurance, that's fine. We just have to say that they had minimum essential coverage. Okay? So that's where that comes into play. All right. So it's still the same, and like I talked about, minimum essential coverage basically is meeting that hospitalization. All right. So we have that. Okay. So we have everything on there so far. All right. Okay. First thing we had on the, first thing that we had on there was that we had Elaine Robbins as a W-2. So we can do a couple different things as far as navigating. We can go to our 1040 page 1, and if we go down to box 7, we know that income ends up on line 7, and we go to the box over there, we can hit F9. It shows all the different things that we could put in there that would be showing up on line 7 as far as income. The one we're going to choose is the one at the top. We're going to get that W-2, and that'll bring that open to us. I'm going to put it under the taxpayer, and then I'm going to check the box there. Okay, and we have an EIN number for them. Okay, and again, we can skip the name code, but if we put in there, she worked for St. Francis. The name code, after I put in the name, it will create automatically. I think I've talked about the fact that you know, in the software, the way I have it set up right now, and as you see the color scheme, if a number or a thing is green, that is something we can put in. If the number of characters are yellow, you cannot put that in. We have it as calculated, and it will be come from somewhere else. Okay. For hospital, oops, sorry, hospital circle. What was my spelling? Okay. Hospital circle. Put that in. We're going to put the wages in. If we put the wages in as they appear there, okay, go in there with the withholding. All right. And the box that lights up here a lot of times for red, it says, please verify federal withholding, Social Security withholding, Medicare. The amounts exceed the Pub 15 guidelines. Basically what that's saying is that there seems to be something that is out of kilter with their filing status on the return as far as withholding. All right, just verify the amount off the W-2 and check the box there so that we have that. On this one, if we look in box 12, there is a retirement code D contribution, probably 401k, and we put that amount in there. We go back up to boxes 3 and 5. You can see that that made the adjustment for us so that it matches what we see on the W-2 in the workbook. Okay, we're going to check, as it did there, a retirement plan. We're going to put in there that they lived in New York. New York does use the federal EIN numbers to identify the employer. And then we're going to put in the withholding that they had, okay, so that we have that on there. All right. Now, one thing that popped up is because they're doing a retirement right now because of their level of income is that 8880 on the left. All right. And we can remember from our non-refundable credits chapters that Savers credit pops up there. Right now, we're not going to address it because we do have another W-2 to put in there. So the way I typically get my next W-2 is I will go right up here to the top in the little white tabs. You can see where it says copy the W-2. I'm going to hit that. And then I'm always going to make sure that I check the box as to who this is for. In this case, whoops, I'm backwards here. The first one was for Elaine. All right. And then the second one for the sales position is going to be for Christopher. Okay. He works at Sales and More. So I'm going to put his EIN number in there. Again, skip the name code. As soon as you put in the employer's name, it'll populate that for you. We have that, and we have our zip code. We have the wages in there for the again, things were a little out of kilter from what they thought they should be. So we have the withholding there. Okay. Same thing that we saw in the previous one. We had, whoops, we had our code D. We had some contributions to some retirement. Okay. Again, probably a 401k. But as we take a look here, that changed our Social Security wages, so it lowered our taxable income. So these are pre-tax dollars if we think about our chapter we just did on qualified and non-qualified retirement accounts. We have New York. Make sure that you check that retirement. All right, so we have that. The other thing that was in box 12 is a DD code. That DD code, okay, yep, that. The DD code, that is the medical. that is another way for you to validate that they had health insurance, because $13,000 is what they have probably paid for Elaine and Christopher's health insurance. So that'll go in there on that DD code. Okay. All right, so we have that. And now, as I talked about on their next page there on 8.7 in your workbook, we have some capital gains or stock transactions, 1099-Bs, okay? One thing I want to note on here is the 8888 went away because their income was too high to qualify for it for a joint return, okay? The other thing is we had a contribution to retirement. I'm going to show you how to do that. Again, we're going to cover that in Chapter 12 when we do adjustments to income, all right? But this is where we're going to have it on this. And what we're going to do is we're going to go all the way down here to our adjustments to income. Again, this is a little early, but I want to put this in and show you how this works in here. So we have line 32, all right, our IRA deduction. We're going to go in there. There's a little worksheet, and it was a traditional IRA, if I remember correctly. Go back and look at it. Yep, traditional IRA that they made the contribution to. Okay, so if we scroll down, there's a little section here, traditional IRA. They each contributed $4,000. Okay, all right. And actually on this, it really had no impact on the federal, okay? The reason being is that they surpassed the threshold. If we look here, maximum modified adjusted gross income for deductible contributions, if we look at this, covered by a retirement plan, yes, all right, okay? As you can see here, they passed the limit. All right, and their spouse is covered by a plan. All right, 119,000. Their AGI is 128, so they got real no bang for the buck here. This would be something that if I were to consult these people, as far as being a client, I would say to them, you know, that's great. I'm happy that you're able to contribute to your retirement, but you would be better off giving that extra $4,000 through your employer, because then your taxable income that comes to the tax return would be less, okay? Because it's just not anything they're getting a deduction for here, all right? So we have the yep, I'll take that one. I'll disconnect it. No, okay. Does the other one have the same number of ports? Yeah, that's fine. It'll work. Okay, that's fine. Yeah, let me take it. All right. All right, sorry about that. IT guys helped me. They helped me fix up, so, all right. Okay. All right, so we're going to move on to the next tax document. It was a 1099-B. Okay. So we're going to go to 1040, page 1. And when we get into there, we're going to scroll down to our income section. And we're going to pass all the interest, unearned income, dividends that we talked about. The unearned them with the refunds and alimony. Again, you know, business income we'll talk about later. You know, that line 12 when we get in chapters 13 and 14. But we're going to go to our capital gains. Okay. So I'm going to go to line 13. I'm going to light up my square on the right, and I'm going to hit F9. Once I'm in there with my F9, this is my capital gains and losses. Okay. So this is my Schedule D. All right. So again, we talked about and we saw in the workbook, or excuse me, the textbook, that we had, you know, all of our transactions, capital gains and losses are reported on the Schedule D. However, on the Schedule D, nothing is reported on the Schedule D, okay? Or, like the Schedule B, short-term and long-term capital gains are not reported here for the software. So I'm going to go down here where it says short-term totals, and I'm going to light up that square, and I'm going to hit F9, and it has this great little worksheet for us, okay? This worksheet is really where we're going to report all of our capital gains or losses transactions. All right. One thing I want you to do, and I'm not sure why the software does this, but when it does this, it takes you to the worksheet. Then I want you to scroll up. And if you do that, you can see here, here's all of our codes that we talked about for the 8949, our letters A through F. Okay. And then we're going to have that correspond to this red column here for the 8949, but it shows the 1099. Okay. Well, our first 1099B we have there, you can see was from Stocks and More, and it was 100 shares of LMNO Incorporated. So I'm going to put LMNO Incorporated. Okay. And then we got to take a little closer look at it. Okay. These stocks were acquired on the 22nd of October 2017, and they were sold on 12/11/2017. Okay, so basically this is short term. We had it less than a year. We also look at this, we do have the proceeds, and the cost basis has been reported. Okay, you can see the box 1 E has the cost basis, and we go down to box 6, and that says that it's been reported to the IRS. All right, so that means we have a short term with the report, or excuse me, with the basis reported, and that's going to be letter A for us. Okay, as it says on here, we acquired 10/22/2017, and we sold it on 12/11/2017. He must have got some advice here, and sales the proceeds were $10,214. Okay, and his cost basis was $13,000. All right, so he lost $2,800. Since this is Christopher Robbins, he must have got poor advice from Eeyore or Tigger or whoever else, but he got poor advice, and you know, they had a loss on this, and so short-term wise. The last column that's over here is short-term or long-term is what that S/L. We can see this is short-term. Okay, all right. Column F and G, where it has code and adjustments, this is where maybe we have a wash sale or something else. If you're in the code box here, you hit F1, it brings up the little help menu, and in there you will find the codes that you can put in there that we have from that. And if we scroll down, all right, it talks about how with the code, how to complete those 2 columns. Okay, so those will have that on there for you. All right. All right, if we go to the next stock, we have, again, from Stocks and More. All right. Excuse me. We have from Stocks and More, we have 750 shares of STON Company. Okay, so we're going to put STON Company. Take a look at this for our classification. Date acquired was 2000. Date sold was 2017. So we have a long term with the basis that has been reported. So we're going to have this in here as a long term with the basis reported. Okay. So we're going to use code D. All right. If you notice on our tree on the left, if everybody takes a look, if you have the tree up there, and we take the tree on the left, you can see that we're doing this quarter capital gains worksheet, but if you look over there, we can see that our 8949s are being generated. Okay, so that is where those, like I said, the worksheet's great. In the textbook, you're going to learn how to do those separately, but if we click on this 8949, I'm going to take a quick look at it. You can see that it lists that other stock transaction that we did with everything we had on there, and it's checked with the right box. Okay, right now we have the 8949 for our STON Company, and you can see that it's on there, but you can see that we haven't completed everything because we're still working on it on our little capital gains worksheet. So 7/16/2000, okay, we have that in there. We're going to have, it was sold 12/11/2017. Proceeds were $12,200. Okay, and our cost was $9,021. So this must have been advice from Piglet, and this was a much better stock transaction on long term. He was patient and held that stock and had that gain. Okay, so that's the way those would go in. Now, all right, I'm going to do one more, just kind of an example to kind of show you some things here in a second. Okay, all right. Okay. All right, so we have here, if we look at our Schedule D, we can see that everything carried over there also. We can see there's our short term and our long term, and everything is calculated on that. Okay, all right. Now, the other thing that we have here is I'm going to show you, is I just want to kind of have this as information for you, is I'm going to do this for an example. Again, this is not for the problem that we have here, but this is one that I'm going to do as kind of an example. And Christopher Robin's got some advice from Winnie the Pooh, and he bought some stock in honey. Okay, this stock was a long term, and the basis was not reported, but we can look it up. But since it was not reported, we're going to use letter E. Okay, and he bought stock several times during the year in the honey. Winnie the Pooh just could not leave him alone, so he made sure that he was interested in buying this honey, and he bought several transactions of it. Well, we don't have to do each transaction as far as individually. If there are multiple, if we put a V in there, it'll fill it in with the word various. So we had several days. Okay, again, he sold it on the date that he was getting rid of stock. Okay, and because I coded it E, you can again look all the way to the right, that S/L, you can see that it's long term, even though I put various in there, and you know that all these transactions are long term. Okay, all right, well, he sold that honey for $1,000. Okay, but it cost Christopher Robbins $10,000. So obviously Pooh was eating all the honey and there was no profit in this business. So he has a $9,000 loss on his transaction. Okay, well, let's look and see what happens with that $9,000 on our Schedule D. All right, so we see that we have a $2,800 loss on our short term, and we have a $5,000 loss on our long term. Okay, so again, between the two of them, we have a very sizable loss. All right, so if we go to Schedule D, page 2, we have a loss total of $8,628. Again, $3,000 is all we can do. Okay, so we have that. So knowing that, and we go to our 1040 page 1, we can see that only $3,000 of loss is taken forward to the 1040 on the capital gains line 13. All right, so that's where we have that. Okay, so you can see how it flows there even with that loss. Now, if you have somebody that's a new client and they say, you know what, I have long-term capital losses of, okay, long-term capital loss carryover, and this would already populate if they're a returning client, but they may say, you know what, I got some advice too from Winnie the Pooh, and I bought that honey and I lost $10,000. Okay, well, you can see now that they have a very sizable net term capital loss, and again, you know, that is calculated on here, and you can see what we're going to have for the capital loss carryover. Okay, but again, we're only using the 3,000. Okay, so that's all we can use on that. All right, so that's the way that capital loss would work on that. Now, we have a house that was sold that Christopher inherited. So we have our capital gains worksheet, and they sold it on 123 Main Street. Okay, and they held it long term, but there was no 1099-B. So we're going to put F on there. It was a house they bought, and they bought it in August of 2000 and let's see, 16, and they sold it when they were liquidating everything here. Okay, so they had that sales price. They sold the house for $50,000. Okay, and the cost basis, they got into it for $40,000. Okay, all right, so we have that. Now that shows up as long term. Okay, so we have that. There was a house that they did get in on long term. All right, now this is where you might use this little column F. There is a code in there, and if you go F1 and you go into it for those adjustments, the codes, inside the code there is a code H that says you sold or exchanged your main home at a gain. Must report the sale or exchange of part on the 8949. Okay, so again on this we're going to put a little code H in there, and we're going to say, hey, we had $5,000 in selling expenses. Okay, all right. Negative there. We had 5,000, so that's a decrease in the basis. Okay, all right. So we have that. So we can see that that adjustment made the capital gains less because that 5,000 makes this adjustment to the basis 45,000 for an increase in the basis. Okay, so that's how you would use that column if you wanted to do an adjustment. All right. Okay. Any questions on the capital gains and using the worksheet and using the Schedule D? Oops. Anybody have any questions there? Okay. For those of you that are TV buffs, the next problem that one of the ones you're going to do from the homework is Will Robbins. Okay. All right. Will Robinson, I should say. Okay. So cost basis entered, then adjustments come out in column G. That's correct. And a lot of times when you have stock transactions on a 1099-B, you won't use that column F and G. This is just a way that you can put on there to note the adjustment to the basis that you made because of selling your home. The one thing that sometimes will happen on a 1099-B is that you will have an adjustment to the basis because of a wash. Where the transaction is basically, you know, bought and sold in such a short time frame that you have coded there. The codes would show up on a 1099-B, but this is a way that you can use those column F and G. Very often you will not use them. Okay. All right. Any other questions on the stock transactions? Okay. All right. Okay. So we are going to go to okay, so we're going to go into chapter 9, and we're going to do a little retirement income. Okay, and we're going to go to page, let's see, in your workbook, page 9.5. Okay, so I'm going to close this return out. Actually, what I'll do here is all this, the extra stuff I put in. All right, so close that return out. And like I said, we're going to do problem 9.1 now. This is going to be a problem that is for Elmer and Elizabeth Jones. A few bullet points here. That Elmer and Elizabeth are filing a 1040A last year. Again, that's an indication that we have no itemized. They'd like to do standard again this year. The refund they'd like on their checking account. And they have a bunch of information, and they had health insurance the entire year. Okay, so we're going to open up with Elmer's social and put that in there for us. All right. Okay. All right, so we have Elmer, middle initial O, and this is Jones. Okay. We have Elizabeth Jones. Okay. And we'll put her social in there. They're doing a married filing joint return. We have their address, living on River Oaks Drive in Grand Island. Okay. And we have their email address. They're up at the Times. They have an iCloud email. So cloud, I could. Okay. We'll put just their cell phone in there for right now for time. Okay. We have their birth dates, and again, do not stress how important it is to make sure you get these in there when you're doing the returns. In this case, we're looking at these birth dates, and we can kind of see we got somebody 67, needs the full retirement, and we have somebody that's 58, and if they're, in this case, we're typing that they're retired, okay, for Elmer. And we have, we're going to say semi-retired because it looks like Elizabeth is still working, okay? So we're going to put her in as semi-retired, all right? Again, don't worry about the box. You can check no if you want to on that Puerto Rico. Married filing joint return, okay? No dependents. They were New York residents. This would be important when we do retirement that we talk about this. We have them in there. We're going to electronically file the return. We have their checking account information. Okay, so we have that in there. About the practitioner, you can just check the tax return that we're doing. Again, for the PIN number, just use their zip code. Okay, so we have that. We'll just check they did not have a license. Okay, so we have this. All right. Okay. I'm going to hold on 1 second here. Okay. Apologize about that. Just had to take a phone call for somebody. So we'll get our main info sheet, main info down at the bottom. Okay. All right, so we have all that in there. Okay. Hello? Hey, Spectrum? Okay. Okay, so we have everything in there for our main info. All right, and as it talked about on there, they are doing a, last year they did a 1040A. So we have in there that we can go to the middle part. That means they did not itemize, and they want to do the standard deduction again this year. They had health insurance all year long. Might see that DD code on the W-2, or we might see a Medicare on the Social Security, but that would meet that. Okay, so we have everything there. All right, so we're going to talk about, we have Elizabeth has a W-2. All right, so for this one, I'm going to go to add a form. Okay, and I'm going to type in there W-2. Okay, and it's going to give me the W-2 form that I'll open up. This was for Elizabeth, so she would be the spouse. All right, address looks good on the W-2. We're going to put in there, she's working for Nutty for You. Okay. All right, so we have that in there. We're going to put her information in there. Looks like it's maybe a part-time job that she has. That $500 seems a little low in the withholding, so so the box kind of reminded us, that red box there, to check it. On this, we had some New York State Disability Insurance in box 14, so we're going to put 1040 in there. Okay. All right. And no retirement plan for her. This was a New York employer. So we have the withholding in there for that one also. Okay, so the W-2 is in there for them. All right, and right now, because of the two of them and where that income is, it does show that there would be an earned income credit. Okay, all right. Next document down here on page 9-7 is our pension. Okay, so I'm going to go to my 1040A, excuse me, 1040 page 1. All right, and I'm going to go down to my lines, and this is where I was talking about line 15 and 16 on the return. I can do either one of the boxes here. I'm just going to take the first one here, and I'm going to go into this. It's going to be a 1099R for me to use. This one is in Elmer's name. I cannot stress enough how important it is on the 1099Rs to make sure that you get the right taxpayer and or spouse on this. So this is a taxpayer, okay, because we talked about the age. We have our address is correct. This is coming from my pension, so we're going to get the EIN number in there. Okay, and we have the payer's name, like I said, my pension. Okay, and that is on 65 Main Street. And we have that. All right. Gross income, $15,000. Okay. Taxable amount, $15,000. All right. We take a look at boxes. Nothing checked there. We did see that he took out 10% or $1,500. It is coded box 7, which means normal distribution and not retirement. So there's no penalty there. And then this is where we do the extra boxes that is for New York State. Okay. So if we look down here on our left, on the bottom, we have A little box here. This is where we're going to check so we can take the New York consideration into account. As from the handout that I gave you, what that is where we talk about 59.5, which is box 1. Box 2 is if this was a state or government pension or retirement account. Box 3 is not used, and box 4 is railroad retirement. Okay, so we're going to check box 1 because we know Elmer is 59.5. Once we do that, we're going to go take a look at our New York. Okay, and we'll clean up a few things here while we're there, since we don't very often talk about New York. But on this case, they are in the Grand Island School District, so we will put that in there. So Erie County and Grand Island. All right, and you can look up the code on that one. All right, no bank accounts, I guess, in the Cayman Islands or Switzerland, and none of this was anything from having any deferred comp that they had going on. Okay, so we have that. We're going to go to New York 201, page 2. So we know that the top comes over from the federal. We see is $15,000 pension on there. And so we have New York additions. We have nothing there, but we do see a subtraction. So you can see here that because he's 59.5, he gets to subtract 15,000 off of his income, or their income, I should say. So that drops their income or gross income for New York to 11,548, and with their standard deduction, they have no taxable income. In fact, if you look at this, roughly would need about another $5,000 of income before they would have one taxable dollar. Okay, so that's where that box comes into play there on the 1099-R. Okay, so if we go back to our 1099-R using our tree on the left, we can see that we go down and we have that box 1 checked. That is how that comes over. In this case, there's no state or local. Really not required because that first $20,000 for Elmer is tax-free, and he doesn't have to pay New York State tax, so no reason for the withholding. Okay. All right, so we're going to go to the next 1099-R. So again, I'm going to use my little tabs up at the top, my white tabs. I'm going to copy that. This one is in Elizabeth's name. She must be getting some money from a previous employer or previous retirement account or something that she's drawing out of. Or maybe they just needed to take money out of one of her retirement accounts for a cruise or something that they were going to take. Okay. All right. And we get the EIN number in there. Okay. All right. So we have that. Payer's name is Harder Company. Okay. And that is 22 Main Street. All right. Okay. All right, so we have that, and we'll say that is an Amherst. Now she decided, like I said, they took out $10,000, quite possibly maybe a cruise or down payment on their dream car as a convertible, whatever that may be, but we have that. Okay, so we have the 2 down there. Okay, and she had, again, 10%. Usually that's a good recommendation. Sometimes they'll mandate 20%. Okay. However, this one is coded 1 because we know that Elizabeth is not 59.5, and we can see that the box is checked here because it is an IRA. Okay, going a little farther down, we can see on this one that there was $320. She knows she's got some tax liability on this because she's under 59.5, so she's not going to get the exclusion like Elmer is on his. Okay, so we have that. Now, even if I check this box, we're not going to get the exclusion because the computer knows because we entered the correct birth date. So if we look at this one, here's what happens with this one, okay? We go to our 1040 page 1, we can see there is the 10,000. And like I said, if you remember, I've taken the box the first time. This made sure got on the pension line. This one got on the IRA or the line, but the 10,000. Okay, we go to page 2 here of the 1040, and we come down and we look at line 59, says additional tax on IRAs, other qualified retirement plans. there is, because Elizabeth is under 59.5, is her 10% penalty to be added to the tax bill. So we can see they had a tax bill of $1448, and then we have a total tax. Okay. Going back to hers, I am going to go ahead and check her box for 59.5. You know, if I did it on accident or whatever it may be, I go over to the New York 201 page 2, and I come down, doesn't show up because she's not 59.5. Okay, so we have nothing there on that. All right. Okay. So uncheck that. Okay. Now, where this is calculated, and I talked about earlier in the workbook, or yes, the textbook, I'm sorry, is on the 5329. If we go look, additional tax on early distributions. I can see here $10,000. There's my 10% tax. Okay. Now, on this, early distributions on line 1 that are not subject to additional tax, we're going to say that they took this $10,000 out, and we found out it was to buy a home. They had been renting, but they finally feel like they have their dream home. They're going to build a log cabin out in the woods somewhere. Okay? So we're going to go in there, and we're going to take a look at our codes there for the additional, the exemption codes. And when we look in those, we can find out that the code is 9 for distributions made to purchase a home. Okay? All right, so we're going to put 9 in there. And we're going to say that they use 5,000 of that as a down payment on the home. Okay? You can do up to 10,000, but we're going to say they just needed 5. Well, if you look at that, I cut my tax penalty in half because I was able to exclude some of that early distribution. Okay? So that's where that's calculated and how we would get rid of that. Okay? So we'll take that out of there. All right? Okay? So that's where that would come into play. Now, we're going to say, though, she got this money, didn't know she had it, and she's going to roll it over. Okay? Well, if it was truly a rollover that was a direct rollover, this code in box 7 would be the letter G. Okay? All right? So this would be the letter G. But right now, we're going to say that she took it, and within 60 days, she rolled it over. So we're going to put $10,000 down here in the exclusion worksheet, that she rolled it over. Okay? So, if we go look at that 5329, we can see the penalty's gone because it's a rollover. It's not a distribution, so there's no penalty. If we go look at our 1040 page 1, okay, we come down here and it shows up as a rollover for 10,000. Now, we might have to go in here and make an explanation. We might have to put in here, let's see, distribution from prior employer, 401k, rolled over to qualified account. Okay, so that'll go in with it electronically to tell the IRS that this is fine, even though it was coded 1. She received it and rolled it over where she needed to do. So it'll show up as a rollover. It is on the indented column, so it is not part of her taxable income. Okay, all right. And you can see with some of these down here that there are some that some other categories where things would be an exclusion worksheet that say that this is not taxable. Okay. All right. Okay, so we're going to take that out of here for right now. Okay. The last thing we have on here is the Social Security. Okay. Going to give you just a little clue for the assignment I'm going to give you as far as homework on the out of the workbook on the one that's going to be railroad. If you take a look here, I gave you the little cheat sheet, but if you notice one other thing that pops up here on the 1099-R, is that if you take a look right here, okay, this box you can see where it says for the 1099 RRB line 7. So that tells us exactly where that information is transferred to from our green railroad. Okay. The other thing is, this is going to give you a little chance to do the simplified method. So if you take a look down at the bottom, okay, we have right here, you can see at the bottom a little spot. Give me a second here. You can see a little spot here where we see the RRB line 3. Okay, so again, these are where, and then you can do the simplified method, and that will show and do the calculation for you as the little cheat sheet I gave you on that handout that I emailed to you during the break. Okay. Well, we have Social Security. So if you look at the bottom of page 9.8, we have Elmer's Social Security. So we're going to go down to the bottom of the income section, and line 20 talks about Social Security. So we're going to go in there, hit F9, bring up our little worksheet, 1040 worksheet 1. And as we can see on there, the top part talks about income for scholarships and household employees where there was no W-2 issue. So this is a spot that you put that. But we're going to be more concerned about Social Security. Okay? Social Security received this year, he got $10,760. Okay? There again, pink and blue, boys and girls together, railroad tier 1, the blue slip, that's where this income would go there, that we talked about with the blue Social Security for railroad. All right, so we have that. Here, this line talks about Medicare's Part B, C, and D that may be taken out of his Social Security. In this case, he had $1,248, and he had $300 in federal tax withheld. Okay, so we have those on there. We have everything in there for that. If we take a look, we go to our 1040 page 1. You can see it flows over there, and you can see the calculation of the 10,760. 4964 is taxable. So because of the other income that they had and the age of the people on the tax return, it did make some of their Social Security taxable. We go to the New York 201 page 2, and we scroll down, we can see Social Security, the taxable amount from the federal is excluded. So they subtract that from those. Very minimal taxable income for somebody that's retired. So their taxable income on the state is $5,400. Their taxable income on the federal, okay, is $19,000. So you can see how income can be excluded on the state side for retirement income to be taxable. Okay. All right. Any questions from anybody? Any questions at all on this? Give a second or two to type some stuff in here. Any questions? Okay. You don't have any questions here? Okay. So that covers, we talked about capital gains and we talked about retirement. So that covers those. Oops, we had one pop up here. Give me 1 second. Pension box 5, not 3. If you look on it, yes. As I said, I apologize that it is not in color, but we're always going to use that gray shaded box. When the actual tax document, it is actually pink. So the pink box is what's going to go into that line. That's the number that we will use. Okay? So yes, use box 5, the pink shaded box. All right? Okay. And catch-up contributions at 18,000. be deducted. Limit is, yeah, the excess contributions, and that would be through the employer for the catch up on that. And then on the tax return, when you do the adjustment to income, yes, it's 55, but you can do catch up if you're over that you could do up to 65. There's that extra 1,000. All right. All right. And we'll talk about that more when we get to adjustments to income. Right now, we're just talking about the distribution, so we'll talk a little bit more about contributions when we do adjustments to income later in chapter 12, which is actually next Saturday. Okay. All right. And speaking of next Saturday, probably on Friday, I'll probably distribute the take home. Send that out. Get it once I get it made electronically. Okay. Would box 3 and 5 be different? So they can be different because if somebody is having a Social Security distribution, it may be the case that some of those things that happen in box 4, as you can see there in little parentheses, box 3 minus box 4. Some of those are things that are repaid. Say that if they took and they worked too much and the whole, for every $2 earned, you got to give $1 back. So things might be different between box 3 and box 5. You don't see it very often. The other thing that can happen sometimes is if somebody's gone on to Social Security disability, and the timing that it takes to get those cases through, you might see where in 2017 they might be paid for tax years 17, 16, and 15. And that's where you do a lump sum election, and that's another topic. So, yeah. All right. Any other capital gains or retirement questions? All right. Okay. Just a few seconds here to see if there's anything else that we have. Okay. All right. Well, great class today. Again, I apologize about some of the interruptions and some of the late delay with the technical, but we are trying to take a weekend and move into our new corporate office. I don't know if you can see, I have new background. You don't see my filing cabinet and my little magnet back there, but good chance. It's 1890 Colvin Boulevard in Tonawanda. If you want to stop by next week and see it, that'd be great. And stop by and say hi. We're going to have extra office space and some other things. So it will be great for everybody if you want to come over and do problems here with me. I'm here most days from about 8 in the morning to about 8 at night between office hours and doing healthcare and other things such. So we have that. But let me know if anybody wants to do one-on-one. Like I said, I'm happy to do that and help people out. I want you to really understand the way the software works, the way the laws work, and the way you apply them. So make sure that we do that. Okay. I'm hoping that technically this will work and I can get the clip of today made properly and get it out to everybody and get the homework assignments out so that everybody has that and you can watch what's on there. Again, EG Tax Web, if you do a search in YouTube, has all the other things that are on there. Okay. All right. So we're in good shape there. Okay. And any other questions on any of the other things that we've covered? Okay. Okay. All right. Well, that's where we're going to stop at for today. Again, I do apologize for the interruptions and such, but we got everything done that's here, so we're in good shape. Okay. A second here, so I close things out. All right. Okay. So we will see everybody next Saturday, the 17th. We do have, we're going to cover like 3 chapters, but they'll be going pretty quick with the itemized and adjustments to income. All right. So we'll see everybody next week. Again, great job on the homework. And let me know if anything else comes up as we go along.